Welcome to the Sojourn Wealth Management Podcast. My name is Corey Akins. I'm here today with my partners Andrew Kraft and Jeff Bronner. We are bringing to you another episode in our Investment Basics series. Today we'll be talking about asset allocation, what it is, its history, why it's so important on the investment front, and hopefully by the end of it you'll have a greater understanding of this vital tool that we use to help our portfolios. So with that, Andrew, Jeff, how are you guys doing today?
Doing great. Enjoying this lovely spring day.
Oh, I'm doing well. I'm excited to jump into this topic.
Yeah, me too. It's a good one, and it's one that is it's really, really important. I mean, there's just no other way to put it, right? And when we talk about investment planning and how we manage assets, this is kind of at the forefront. So I thought I'd give just a brief definition and then kick it over to you, Andrew, for a brief history. So asset allocation, kind of at its bare bones, right, is the process of dividing your investment portfolio among asset classes, different asset classes, to balance your risk, return, and time horizon. Essentially, the main idea is that different assets behave differently in various economic conditions. So that diversification reduces volatility. And with that, Andrew, tell us a little bit, just kind of the history behind this thought.
Yeah, happy to do that. So I think it really became popularized perhaps by Harry Markowitz, who won a Nobel Prize in the 50s, developing what's called modern portfolio theory. And essentially, it's just a framework that maximizes returns for any kind of given level of risk by creating diversified portfolios. So when looking at a specific portion of an investment or that asset, it should kind of be measured on how it contributes to the overall portfolio as opposed to it in isolation. But this idea has been around for a while. I was doing some research and stumbled upon the richest man in history back in the 1520s. If you looked at his money in today's dollars, he'd have over 400 billion. So Jacob Fugger suggested that you should have your fortune in 4 different asset classes: stocks, real estate, bonds, and gold. And so a lot of folks want to own a house or in the process of building that equity. So that's the real estate portion. And then, we'll kind of mention later that we're trying to add precious metals, or we have added precious metals to our investments as well. So those are just kind of 4 different asset classes. Building on Harry Markowitz's work in the 80s, Brinson, Hood, and Biebauer did a study that showed roughly 90% of a portfolio was due to the asset allocation and not things like active stock picking or other features. So that was an important study and just kind of added steam to the popularity of indexing. In the early 2000s, there was a study done by a leading provider for retirement plans of educators, and they found that about 80% of the plan participants had either 0% in equity, so 100% fixed income, or 100% equities. So neither of those were really well, diversified among the different asset classes, and kind of just bring it up to the present day. We're creating portfolios that do try and add some additional asset classes just to create that more efficient risk or reward ratio. So
yeah, and we've seen new asset classes kind of arise, right? Like if you think about the alternative space in that area, there have been things that have evolved over time that we're now kind of adding in. So that's the what and the history behind kind of asset allocation. The how, or the way in which advisors do this, Jeff, what does that look like?
Yeah, there's 2 primary methods that are applied when looking at asset allocation. The first one is strategic and the second is tactical. When we talk about strategic asset allocation, we're looking at a risk and goals-based allocation model. Essentially, an investor or a household will articulate goals and then, evaluate time horizon to those goals and articulate their risk tolerance. And then you factor all of those together to come up with what is an appropriate way to allocate their assets. What's the weighting? How much growth do they need to pursue, or how much conservation do they need to pursue? The tactical method takes a similar approach, but then you add a layer to that to say, okay, what's the economic conditions? What's the current economic climate? Is it recessionary, or is it or is there growth anticipated in the coming months, coming years? And then adding that as a filter to how to allocate those assets as well to take advantage of those opportunities or to hedge against any sort of downturn that might arise.
And you were talking about the risk and the goals for really for both of them, but I think in the sense of the strategic, you pick one of those portfolios, and then because the market's going up and down, the 60/40 is now 70/30, and so
Right.
you just rebalance back to 60/40, or I think you imply the objective has changed, and
Mhm.
so how should we allocate the assets now based on the new information?
Right.
Yeah, and it lies closely, like, adjacent to what we would call diversification, but different, right? So when we're talking about asset allocation, it's not so much the drilling down into each individual company that you're, across the spectrum, but more so those broader thoughts of the asset classes. So with that, how does diversification, how does it essentially mitigate risk in the portfolio over time?
Yeah. So if you're, again, the 60/40 portfolio, if there's 60% stocks, then you think, okay, how do we diversify that 60%? I think that's where you get into the different market caps. So large companies, small companies, geographical, foreign, domestic, some other areas where you try and get zig and zag together, so
Yeah.
to speak, so you have a smoother ride overall.
Okay. Um, you mentioned regional. It can also be things like sector, legislative, right? Like we're kind of seeing, we've seen some of that over the last several years. And you talked a little bit about portfolio weighting and analysis, Jeff. Explain what that is when you're looking at how to properly allocate a portfolio. Like, what are you looking at there? How are you doing that? And again, why is it so important?
Right. So once you nail down the goals and the risk tolerance of the client, now you have an idea of this is an appropriate portfolio for them. Then there's a lot of variance between this 60/40 portfolio and that 60/40 portfolio. And so, you can have a 60/40 portfolio and the entire equity portion of that is invested in one company. So that gets to that point.
Or all tech.
There, or all tech, exactly, one sector. So we want to make sure that is diversified across those different sectors, to make sure you have it, good exposure in tech, good exposure in telecommunications, healthcare, so on and so forth.
Consumer staples.
Exactly, yeah. And mention regional or geographic when we talk about different locations, different events, whether it be like a natural disaster or something like that, is going to affect different locations in the world at any given point in time differently. And so, if you have a tsunami that affects an international company, you want to make sure that your whole portfolio isn't invested into that one company. So we want to make sure we diversify across sector, region, geography,
Yeah.
so on and so forth. There's a couple other things as well. Andrew mentioned the large companies versus the small companies. It's called market capitalization. Want to make sure we're diversified across there. And then maybe the last one I'll touch on for the sake of time is legislative and policy risk. Different industries, different sectors, different companies are going to be affected by legislation that comes out. And so you want to make sure that you're not overly exposed to that risk if something were to happen legislatively.
And it strengthens the portfolio, right? So it brings, in a lot of ways, it solidifies the portfolio against risk, but also long term for like what you wanted to accomplish, risk based versus goal based, and all of that. So
that term strengthens the portfolio is good because we started with a little history, want to end with a little chemistry, which is not my wheelhouse, but I've always kind of this analogy's always kind of stuck with me. You have iron, carbon, chromium, and nickel, and all the chemical engineers, there's probably something else. But
I'm following. Yeah, I'm right there with you.
Just four. So iron can be subject to rapid corrosion. Carbon is really soft. Chromium is powdery and flaky, and by itself, nickel is very malleable. So none of them are particularly strong on their own, but when you bring them together, what do you have?
Steel.
Stainless steel.
Okay.
Which is very strong, won't corrode. And so by kind of bringing, it's kind of like asset allocation, by bringing these different components together, each asset class, for example, can suffer corrosion, if you will, or market loss or volatility, but combining them, you can have a really strong portfolio.
Mm-hmm. That's good. I think it highlights a few different things. It's not just a technical term. It's really the foundation of long-term investment planning. And so how you divide your money between stocks, bonds, alternatives, so forth and so on, really can create a portfolio that accomplishes what you want and stands against the test of time. So with that, thank you, listeners. We hope you found this valuable, and we look forward to doing it again.
Thank you for listening to this episode of the Sojourn Wealth Management Podcast. This is a friendly reminder that all content in this podcast is intended for educational purposes alone. Nothing in this episode should be treated as tax, legal, or investment advice. We encourage you to consult your financial professional for any of those needs. Securities offered through Kestra Investment Services, LLC, Kestra IS, member FINRA SIPC. Investment advisory services offered through Kestra Advisory Services, LLC, Kestra AS, an affiliate of Kestra IS. Kestra IS or Kestra AS are not affiliated with Sojourn Wealth Management, LLC.